and it is actually put together for members of the association and the general public to be abreast with the latest trends in terms of tax incentives to manufacturers in Nigeria. My pleasure to welcome everyone. First, I would like to introduce and welcome the Director General of the Manufacturers Association of Nigeria in the person of Mr. Segun Ajayi-Kadir, MNI. DG, good to have you. You're welcome.
Thank you so much. Good to be here.
Thank you, sir. Next, it's my pleasure to introduce Mr. Wale Ajayi, Partner and Head of Tax, KPMG Africa. Mr. Ajayi, good to see you. You're welcome, sir.
Thank you so much. I'm happy to be here.
Thank you very much. Next, we have our guest speaker for today in the person of Ms. Elizabeth Olaghere, who is the Partner and Head of Tax Incentives, KPMG West Africa. Elizabeth, good to see you, and you're welcome to this webinar.
Thank you. Good morning. A pleasure to be here. Thank you.
Also, we have the representative of the Federal Inland Revenue Service, who is Mr. Lucky Obodeke, Director in charge of large tax manufacturing and others, who is ably represented this morning by Mr. Matthew Osanikwe, Deputy Director, Tax Policy and Advisory. Mr. Matthew Osanikwe, good to have you. You're welcome.
Yeah, thank you. It's my pleasure to be here. Thank you.
Thank you very much. We also have our esteemed members, colleagues from the Manufacturers Association of Nigeria, gentlemen of the press. It's a pleasure to welcome you once again to this business webinar series. First, I would like to invite the Director General of the Manufacturers Association of Nigeria in the person of Mr. Segun Ajayi-Kadir, MNI, to please give the opening remarks. DG, you have the floor, sir.
Thank you very much, Segun, and thank you again, everyone, for joining us. I have a prepared speech, which, if I read it quickly, I'll be saving us time, and I promise not to divert away from the speech. So, good morning, distinguished members of MAN, esteemed partners, our guests and colleagues. I'm honored to welcome you all to this important webinar on catalyzing growth in a turbulent economic environment, the role of tax incentives. This is co-organized by MAN and KPMG. The webinar is a key component of our value-add services to members, aimed at enhancing their profitability and boosting their resilience in the face of mounting macroeconomic and other multifaceted economic environment challenges. We are all acutely aware of the challenges confronting the manufacturing sector in Nigeria. This has been accentuated by the prevailing heightened foreign exchange volatility, reverberating effect of the removal of fuel subsidy, inadequate infrastructure, high electricity tariff, and insecurity. Also of particular concern is the perennial challenge of multiplicity and high rates of taxes and levies by the three tiers of government and their agencies. All these and other external factors have combined to create a challenging business environment for manufacturers in Nigeria. In the face of these challenges, it is imperative that we explore all avenues to remain in business, surmount the hurdles, and contribute to the much desired growth in our economy. One of such avenues that could be better deployed is the utilization of tax incentives. Tax incentives play a crucial role in reducing production costs, driving investment, encouraging innovation, and ultimately fostering economic growth and development. Through tax incentives, the government can effectively incentivize businesses to invest in key sectors, create jobs, and drive productivity. By reducing the tax burden on businesses, especially in times of economic uncertainty such as this, the government can provide much needed support to manufacturers and other economic actors. We should therefore intensify efforts and strengthen our collaboration in the advocacy for crafting and implementing targeted tax incentives that will support the growth and sustainability of the manufacturing sector in Nigeria. The incentives should be sector-wide and implemented in a transparent and sustainable manner, devoid of sudden disruptions and indiscretions. In a related and supportive manner, it is important that we raise our voices in support and of the expedited and unfettered implementation of the outcomes and recommendations of the Presidential Committee on Fiscal Policy and Tax Reforms. In addition, we should explore other avenues for strengthening transparency and accountability in governance. A just tax regime and responsible government spending will engender voluntary tax compliance and boost government revenue for the benefit of all. I encourage all participants in this webinar to actively engage in discussions, share insights, ask relevant questions that will enable us to discover and harness the benefits inherent in the use of tax incentives to catalyze growth in our economy. I would like to express my gratitude to KPMG for their partnership in organizing this webinar. Mr. Adewale Ajayi, my namesake, and Ms. Elizabeth Olaghere of KPMG are with us today, and we are very thankful for the support they have always given us. Quite importantly, I would also like to thank Mr. Lucky Abodeke, I hope I didn't kill your name, Director, Large Tax Manufacturing and others at the Federal Ministry, at the Federal Inland Revenue Service for honoring our invitation. He is ably represented by Mr. Matthew Osaneku, Deputy Director, Tax Policy and Advisory Department. In all, we commend all participants for their commitment to advancing the interest of the manufacturing sector in Nigeria. Together, we are creating the critical mass of opinion and advocacy content that will promote the recognition of tax incentives as veritable catalysts for improved productivity and overall growth and development of our economy. I again warmly welcome you all to this webinar and thank you all for giving us the opportunity to serve you. Please enjoy the seminar. Thank you very much.
Thank you very much.
Thank you very much, Director General, Manufacturers Association of Nigeria, Mr. Segun Ajayi-Kadir, MNI, for that wonderful, wonderful opening remarks. Next, it's our pleasure to invite our facilitator for today's webinar, our guest speaker, in the person of Elizabeth Olaghere, who is the partner and head of tax incentives with KPMG West Africa. So please come up with a presentation, and we advise participants to please listen in attentively, make your notes, your comments, and reserve your questions to be asked at the appropriate time. Ms. Elizabeth Olaghere, you have the floor. Thank you very much.
Thank you very much, Dr. Segun, for that introduction. Good morning to our distinguished guests, and it's a real pleasure to be in your midst this morning. I'm talking about this very important topic, catalyzing growth in an economic turbulent environment. What is the role of tax incentives? That's the question. And I think this topic at this point in time will continue to be a subject of great debate. especially when you look at the economic climate and that delicate balance between the budget deficit and then also creating an enabling environment for economies and sectors to thrive. So it will be very interesting during the next couple of minutes, us going through this topic, just to see how there can be that level of balance between the manufacturing sector and generating revenue for the government. So in the next couple of minutes, I'll be talking through the Nigerian economy just to provide a brief overview of key economic indicators. And then we'll talk about the overview of the manufacturing sector specifically. And then, of course, the DG had already laid out some of the key challenges that plagued the manufacturing sector. So I'll just touch on it very briefly. And then we talk about tax incentives, and then some focus on pioneer status incentive. And then we'll bring this all together and land it safely, hopefully. All right, so next slide, please. Now, in terms of the key economic indicators, based on 2023, the year ended up with a 2.7% GDP growth rate. There's a global prediction that it could end up within the range of about 3%, 3.1, some say 2.9. We are predicting, that is KPMG is predicting potentially a 3.1 rate at the end of the year. One of the other key indicators that has continued to plague the economy and particularly the manufacturing sector is inflation. As at June 2024, we had inflation at about 35%. So this is headline inflation we're talking about. And there has been some strategic response to inflation by the central bank, which is very reflective of the typical response to curb inflation. And that is to increase the monetary policy rate. We've seen the monetary policy rate go up by 50 points to about 27% as at July 2024. So this is indicative of a move by the Apex Bank to try and curtail inflation and also to see if foreign direct investment could also play a role in shoring up our foreign reserves. Now, when we look at foreign investment inflow, you could actually say that some of our monetary policy measures are starting to take effect because you can see a very stark increase from our foreign investment inflow in Q4 of 2023 from $1.1 billion to $3.4 billion in the same quarter in 2024. So it is apparent that the monetary policy measures are starting to finally taper through our financial systems. But the key question to ask is, in foreign investment inflow, what element actually relates to foreign direct investment and foreign portfolio investment? And that is where the manufacturing sector will continue to require support, because in economies throughout the world, the manufacturing sector continues to play a key role in developing the sustainability of economic growth. We're seeing that the foreign investment inflow increased, but there was actually a decrease on year quarter for the foreign direct investment. So this is reflective of the sentiments of investors, which is more of a short-term approach, as opposed to a medium to long-term, which is what will drive sustainable growth. When you look at the tax to GDP ratio, we ended 2023 with 10.86%. And there's a very strong ambition by this current administration to increase that tax to GDP ratio to about 18%. So we'll be seeing a lot of activity within the tax hemisphere in the coming months, as we're already seeing, and in the years to come. Next slide, please. Now, when you look drill down into the manufacturing sector, we're seeing that the manufacturing sector is contributing about 10% to the GDP, despite its potential to significantly create economic prosperity by job creation, import substitution, multiplier effect of backward integration. So there have been measures by the government to see how this contribution can be increased. But these measures need to continue to be expanded and targeted towards the manufacturing sector so that the value can really be harnessed and flow through the system while the benefits are then finally being experienced by the common individual of the country. Next slide, please. When you look at manufacturing and you compare it within the context of export, Nigeria still has a long way to go. The manufacturing sector is still underperforming when it comes to export. At the moment, if you compare Nigeria to other African countries, we're only at about 5% of our manufacturing is exported. So there's significant room for improvement, and that boils down to the cost of production. There's a lot of concerted effort towards ensuring that manufacturing in Nigeria is competitive. But there must be policy measures to ensure that these manufactured items can be competitive in the global market, just to enhance the contribution of manufacturing sector to the entire GDP of the country. The DG had eloquently talked about some of the key challenges in the manufacturing sector. I won't spend so much time on it because most of you already know exactly what is on this slide and you feel it on a day-to-day basis. So talking about multiple taxation, limited access to finance. We talked about the increase in the MPR rate. As you can see, it is a double-edged sword. On the one hand, it could help to taper down inflation and also potentially see influx of foreign investment, but at the same time, it could also cause a problem with access to finance, particularly for manufacturing companies that are trying to curb cost. So access to finance is a significant issue that manufacturing companies are facing. Infrastructure deficit is and has been historically a structural problem for manufacturing sector. And that's because we're seeing a high cost of power, we're seeing a high cost of supply chain, and we're seeing a lot of issues with the ports. Although there have been concerted efforts to help decongest the ports, but Nigeria still needs to reduce its reliance on importation. A significant amount of money was spent on importing by the Q2 of 2022. Nigeria was seen to have spent 5.3 trillion naira on importation. So these have significantly driven up the production cost and also caused a friction in the supply chain. COVID-19 accelerated supply chain disruptions. We're seeing some regularization, but it's high time that Nigeria starts to provide an enabling environment where manufacturers can have that pivot from import dependency to being able to sustain a seamless value chain across the manufacturing process. Insecurity is also an issue which has affected foreign direct investment, and the government is trying to implement measures to curb security, but this will continue to also be a factor that affects the supply chain and the production value chain in the manufacturing sector. Now, the question is, how can these challenges be addressed? Tax incentives on the one hand can play a role, but it is very obvious that in the first instance, this has to be within the context of an enabling business environment for sustainable growth to be enhanced within the manufacturing sector. And for Nigeria to achieve its projected economic growth, the government must implement policies to stimulate growth within the sector, because the sector singularly has the potential to exponentially bring Nigeria into a place of sustained economic development for the purpose of the citizenship and even for the purpose of the global economy within Africa and on the international scale. Tax incentives are vital tools that governments have used to attract new investments. It's about how the government wants to measure the benefits of the tax incentives and the cost of the tax incentives. Now, when we look at some of the challenges that we had highlighted in the previous slides, I talked about financing, and I'm sure a lot of manufacturers in this webinar would bear witness that financing could be a challenge. So the tax law does recognize this, the government recognizes this, and there are various instruments within the law that help to enhance foreign borrowings and even local borrowings. So one of such is partial withholding tax exemption on foreign loan, subject to meeting certain conditions. So you could have up to a 70% exemption on withholding tax on foreign borrowed loan if you meet the specific conditions for those exemptions. Also, interest on foreign currency domiciliary account is exempted from companies' income tax. Interest also accruing on deposit accounts of non-resident companies is exempted from taxes, corporate income tax. To help companies also facilitate their importation of plant, machinery, and equipment, some equipment have been specifically designated for import duty exemption, and some of that is functioned and implemented through the import duty exemption waiver. We've also seen fiscal policy measures that were introduced specifically to eliminate and reduce tariffs on equipment used for CNG, LPG, in alignment with the government's initiative for the gas transition. Now, when you look at the construction phase of a manufacturing company, there are also incentives that can be considered. Some of the examples are, for instance, a company that is export-orientated can consider setting up in their entity in a free trade zone, which is a special economic zone that is exempted from foreign exchange regulations and tax regulations. Of course, there are certain conditions and the requirement to file tax returns. The withholding tax rate also on road, bridge, building, and power plant contracts was reduced from 5% to 2.5% in recognition of the low margins in such contracts and also to enhance construction. When we move on to the operational phase, we had talked in the previous slides about multiple taxes. There have been concerted efforts by the current administration through the Presidential Committee on Fiscal Reforms to harmonize the taxes that the companies are currently exposed to. There's also the introduction of progressive tax rates that was introduced in 2020 to ensure that companies that met a certain threshold were exempt from tax. So companies that their turnover was between 0 to 25 million had a 0% tax rate. And then if your turnover was between 25 to 100 million, your tax rate was 20%. So we're seeing the progressive tax rate trying to help new and emerging companies and SMEs. And this is in line with global best practice. We've also seen the Pioneer Status Incentive, which has been a tax holiday structured to help industries that have been established to require more focus within the economic framework of Nigeria, where for instance, the president is satisfied that there's still room for these industries to be carried out on an economic scale that will benefit the country. Manufacturing is a key beneficiary of Pioneer status in the approved list, and we have various industries, subsectors within the manufacturing sector that will qualify for Pioneer status incentive subject to conditions. We had talked in the previous slide also about the underperformance of export, manufacturing to the export framework. And for that purpose, the tax framework, both from direct and indirect tax, is replete with numerous incentives for promoting and incentivizing exports. Some of such exports is the exemption of export profits from CIT, subject to conditions. To relax those conditions further, there was a further elimination of the requirement to repatriate the proceeds from exports into the country for the purpose of qualifying for this exemption. To the extent that you demonstrate that your export proceeds are used to purchase plant, machinery, equipment, raw materials, and spare parts, you will be exempt. Your profits from your export business will be exempt from companies' income tax. Also, profits of companies whose supplies are exclusively import for the manufacturing of products for export are also exempted from corporate income tax. The Export Expansion Grant Scheme is another initiative administered by the Nigerian Export Promotion Council, helping to promote value addition in the export chain. There's also an exemption of VAT from exports. There are other incentives that can help promote infrastructure deficits, some of which include the road infrastructure development and refurbishment investment tax credits. And this essentially seeks to incentivize companies that partner with the government in the construction or the refurbishment of eligible roads, and they will be entitled to a tax credit in the form of what they've expended and also an uplift. Intra-Africa trade will continue to be a very important element for projecting Africa and for developing the African frontiers for growth. So the African Continental Free Trade Agreement and the ECOWAS Trade Liberalization Scheme will continue to be very important in promoting African trade. And for that purpose, incentives which create a free barrier and free movement of goods within the corridor will also help enhance the production within the African continent. Next slide, please. Now we'll take a focus on the Pioneer Status Incentive, which exempts a company from tax holiday for 3 years in the first instance, with the potential of a further 2 years. The tax holiday is seen as an ability for a company to stabilize its operations for the purpose of plowing back to expand its operations and scale its business operations. We've seen in the past where, for instance, the telecommunication industry, the manufacturing sector were granted pioneer status incentive, and subsequent to their post-pioneer period, we've seen exponential increase in the taxes paid by them because of their ability to plow back into expansion facilities and expansion initiatives in their businesses. In 2015, the tax incentive was suspended to pave the way for a reform. As I'd mentioned, there's a lot of conversation about the benefits of tax incentives and the ability to measure it. And in August 2017, there was a new era and a new dispensation of Pioneer Status Incentive, which saw the federal government issue guidelines and a new list of pioneer industries for the purpose of enhancing the benefits to the economy. Specifically, the incentive was sought to help target the incentive towards economic sectors that the government was seeking to promote and propel. I'll be talking a bit more about the benefits of this incentive to companies in the manufacturing sector. Next slide. So for a company to be eligible for this incentive, you are required to apply within a year of commencement of commercial production. And this is one area where we see a lot of bottlenecks with manufacturing companies. Companies that seek to enjoy this incentive somehow find out maybe when they've already advanced in their operations or when they are just at the tail end of the expiration of this 1 year period. So it's very important that companies are aware of tax incentives as they start to incorporate or potentially set up new companies. Of course, one of the critical elements is that the company must be engaged in an activity listed as a pioneer industry or product. You're also required to have fixed assets of 100 million and above, and you must provide evidence of all required legal and regulatory compliance documents. Some of these documents that are very essential to obtaining this incentive is evidence of compliance of employee-related compliance certificates. During the review of the incentive administration in 2017, one of the initiatives that the pioneer status was promoted to enhance was compliance with employee-related taxes and levies. Globally, it has been known that employee-related taxes is one of the highest revenue generation for tax authorities throughout the entire taxing framework. And the reason for this is because when there is employment and economic prosperity within individuals, there's the higher propensity to also generate personal income taxes. And the pioneer status, in some measure, is also complementary to the efforts of government to ensure that companies comply with their employee-related taxes. And that is why companies that want to benefit from the incentive must demonstrate that they have complied with employee-related taxes. Another tangible impact that must be measured through the incentive is employment generation. As we all know, employment generation is very synonymous to economic development and inclusive growth. To that extent, the pioneer status is very focused on targeted employment generation and skill and technology transfer to Nigerians. And that is why the NIPC on an annual basis are required to measure the employment generation and even the emoluments that are paid to employees of manufacturing companies or companies that benefit from this incentive. It is actually no wonder that the government is looking to potentially also introduce other incentives that could see tax relief for companies that increase their employment generation. We have seen this type of tax incentives in the past where companies were able to enjoy a 5% tax credit on employment generation, although it had a sunset period because it was targeted, which is some of the benefits of tax incentives, having the ability to measure the benefits and also wind it down once the objective is achieved. Other critical elements for the pioneer status is export development, import substitution, and infrastructure developed. As I had mentioned previously, significant amount of money was spent by manufacturing companies in importing raw materials into the country. If this is conserved, we'll see a significant reduction in foreign exchange requirement for imports. Now we go down to the benefits for manufacturing companies. For everyone sitting in this webinar that could have a pioneer status incentive, what exactly is the direct benefit to you? Some of these benefits, and one of the critical benefits, is the exemption of your pioneer profits from companies' income tax and tertiary education tax during the pioneer period. Also, your dividend that you declare to your shareholders will be exempt from withholding tax to the extent that this dividend is ring-fenced in a special account based on Section 17 of the Industrial Development Act. And this is just for the purpose of tracking. Your capital expenditure also incurred during the tax holiday period will be ring-fenced and expected to be used for the purpose of reducing your taxable profits once you exit the tax holiday period. Also, your net losses during the tax holiday period can be carried forward to your post-pioneer period. That being said, it must be reiterated that tax incentives must be measured. So on the one hand, when you have the government relinquishing profits or expenditure, relinquishing its income to the company for the purpose of expansion, it then becomes very imperative that there's quantitative and qualitative measurements of this tax incentive and the benefits to the economy. For that purpose, the NIPC is expected to receive an annual performance report from a pioneer company on the 30th of June following the year that the tax incentive was granted. This is expected to be done annually, and this documents the import substitution plans of the company, employment generation. It enables the NIPC collate all this data and measure it through the impact assessment reports and surveys that the NIPC is expected to carry out. In addition, a pioneer status company is also supposed to process something called a certificate of qualifying capital expenditure from the FIRS. This essentially will help the company document and certify its assets pre-pioneer and at the point where it seeks to process an extension. Next slide, please. So at this point, I would like to commend MAN for for providing a platform for us to exchange ideas, particularly in this economic climate. It is no doubt that tax is a vital and sustainable way of generating revenue for government, where tax systems are functional. That being said, tax incentives will continue to play a significant role in stimulating economic growth and providing an opportunity for manufacturing companies to grow exponentially. A review of tax incentive framework is currently underway, and this is also in alignment with OECD requirements and global best practice. This also must be done to ensure that the taxing rights of Nigeria is protected within the context of the global minimum tax frameworks under base erosion and profit shifting of Pillar 2. Whilst MAN's mandate of advocating for a conducive environment is recognized, it's imperative for MAN to continue to encourage its members to take advantage of available incentives and advocacy opportunities. This will foster sustained business growth in the midst of the economic climate. Thank you very much for your time, and we look forward to having an interesting and engaging panel discussions. Thank you.
Thank you very much, Elizabeth, for that wonderful and insightful presentation. I call it a compendium of tax. You have given to us the totality of tax in just about 12 to 15 minutes. Wonderful, well presented. Thank you once again for your presentation. Next, I would like to invite Mr. Lucky Obodeke, Director, Large Tax Manufacturing and Others, who is ably represented today by Mr. Matthew Osanikwe, Deputy Director, Tax Policy and Advisory. Mr. Matthew, we would like to have your own insight into the world of tax incentives from the point of view of the regulator, the Federal Inland Revenue Service. Mr. Matthew, you have the floor.
Yeah, thank you very much, moderator. I'm glad to be on this call. I want to thank Elizabeth for that wonderful presentation. My thought basically is that over time, the federal government has, can you hear me, please?
Yes, Mr. Matthew,
yeah,
we can hear you. Could you please put on your video as well? Great, great.
Yeah, thank you very much. Yes, thank you very much. You see the federal government over time actually has done a lot supporting MAN, especially the Manufacturing Association of Nigeria. When you look at the provisions of the tax laws, you see that there are various incentives that the government actually inserted, enshrined in those provisions of the law to support manufacturers. Elizabeth has mentioned a few of them. He has mentioned the pioneer status incentives, which gives tax-free period for 3 years, and upon satisfactory performance, it can be extended to additional 2 years. So that is taken. So MAN members can take advantage of that. And also, when we look at the provisions of CETA, also Section 23 actually has a lot of incentives that members can actually.
Sorry, Mr. Osaniku.
Yes.
Could you please increase your volume, or you get closer to your device? Thank you, sir. So that we could hear you audibly.
Yeah. So I actually said that when you look at the provisions of Section 23 of CETA, there are a lot of provisions there, tax provisions that are actually exempt some profits. Elizabeth has mentioned some of them. Those profits of companies that are operating within free trade zone are exempt, provided that they operate within the free trade zone from federal, state, and local government taxes, from all taxes. Those companies whose inputs, to the manufacturing are majorly actually exempt from taxes. Also, small companies whose turnover are below 25 million in a tax year are also exempt from all tax, provided that they file the tax returns. Manufacturers are also given what they call accelerated capital allowances that can also be explored to ensure that the profit, the taxable profit is actually, the exposure for taxable profit is actually reduced. There are also a lot of efforts to support the manufacturing sector. When you look at value-added tax, there's a lot of exemption that have been put out there for VAT. So, so MAN members can also take advantage of that. Also, we also have a lot of tax incentives that can actually be enjoyed by the members of MAN from value-added tax. Let me mention a few of them. If you are into manufacture of products, you are actually exempted from VAT. All medical and pharmaceutical products are exempted. Baby products are exempted. Fertilizer, locally produced agricultural and veterinary medicine are exempted. Plant and equipment, plant and machinery imported for the use for the export processing zone are exempted. Then also, we also have a provision in section 39 for those that actually are utilizing gas, what we call GUI, gas utilization incentives. So that is another tax incentive that is available for members that actually into gas utilization. Maybe you have your power plant and you can actually explore that provision. So what that provision entails is that you are given accelerated investment allowance of 35% in lieu of the tax-free period. So if you earn for the tax-free period for the first 3 years, an additional 2 years are subject to satisfactory performance. Like Elizabeth mentioned, that will be after the first 3 years, there will be evaluation of the impact of the first 3 years. So
Hello, Mr. Osaneku. I guess he's having some network challenges. Hello, Mr. Osaneku. Can you hear me? Okay. If you can hear me, maybe you could log out and then log in again.
I was going to suggest that, he might just turn off his video, maybe because of the bandwidth.
Oh, okay.
Yeah.
Or maybe you could
So,
also turn
Matthew,
off your
okay,
video
yeah.
because of the bandwidth. Exactly. Thank you very much. So,
Matthew, are you there?
hello?
Can you hear me? Can you hear me now?
Okay,
can you hear me?
Please go on. We can
Yes.
hear you now.
So I said government over time has continually issued some statement which actually seeks to support the manufacturing sectors. We could see recently there is this inflation reduction and Price Stabilization Fiscal Policy Measures, Order 2024. Though that order has not been officially gazetted, we're actually expecting the official gazette. Also, very soon there will be a new withholding tax regime that is still in the works. That order too, we're expecting it to also be gazetted, and also aware of the interest of the federal government on gas utilization, the issue of CNG to be exempted from value-added tax, and several interventions the government actually rolling out over time to ensure that the rich sector, which manufacturing sector, actually grow the economy. Because the rich sector, it will actually grow the economy. When the rich sector is actually viable, there will be employment generation, and that also add value to the growth in GDP, because the government has actually given us a very tall order to move from 10.4% tax to GDP ratio to about 18%. But basically, as you're also pursuing taxes, also see that government actually over time has been rolling out several interventions to ensure that there is growth and sustainability of the manufacturer. Also, there are also other incentives that can also enjoy. That there is an export expansion grant that is being coordinated by the Nigerian Export Promotion Council, so they can also explore that grant. That grant seeks to support export, and also agree with me, when you are 100% export oriented, all your profits are exempt, provided that we have 100%. So if there's 100%, tax will accrue proportionately. So these are some of the incentive we have in the provision of the law and tax laws to support the manufacturing sector. So I think I can wait for questions to some of those issues that Elizabeth had raised. That basically the government is committed to continue to support manufacturing sector to ensure that they stimulate growth within that sector using tax incentives. So thank you very much.
Thank you very much, Mr. Matthew Osaneku. We appreciate your contribution and your presentation this morning. We would like to take questions from participants and attendees. Please make use of the chat box for your questions and comments. We already have some, and I will be reeling them out. The first question I have here is, what exactly are the requirements to qualify a company for pioneer status incentive? Itemized, one after the other. And I think this question is directed at Elizabeth. What exactly are requirements to qualify a company for pioneer status incentive? Elizabeth.
Okay, thank you very much. Thank you, Dr. Segun, for that question. I mentioned that in my presentation, one of the key requirements or eligibility criteria for the pioneer status is that you must, first of all, have invested and are operating in a pioneer industry or pioneer products. So the pioneer status list was gazetted in 2017 and is replete with various manufacturing activities, starting from the manufacturing of food, agri-products, textile, equipment, manufacturing of medical equipment. So all the manufacturing activities that are covered in the gazetted list are, in the first instance, the basis that gives the company the eligibility to apply first as a preliminary criteria. And then the other conditions to qualify is that you must obviously be a Nigerian company. So you must have been registered in Nigeria, although you can be foreign owned, but you must have a registered entity in Nigeria. Then you must have applied. This is one element that is very important. You must apply within a year of commercial production, and that's where some companies fall fully. Another criteria that is important is the need for you to also have assets of a fixed asset base of 100 million. And then you present a business case. Your business case must demonstrate that you are contributing to the economy from the perspective of employment generation, sustainable growth, import substitution, export potential. Finally, you would undergo a due diligence by the NIPC, where they would conduct a review of your legal documentation, some of which I had mentioned earlier, which includes your incorporation documents and then your compliance certificates for employee-related levies and taxes. So those are some of the key requirements for assessing the eligibility of a pioneer company.
Okay, thank you very much, Elizabeth, for that response. The next question is directed at Mr. Matthew Osaneku. The question is, what happens when I make losses during the pioneer period? Is there any consideration that is given to a company that has gotten the pioneer status? And if this organization makes losses, what happens to the status?
Yeah, thank you very much. When Elizabeth was rolling out some of the benefits of the pioneer status incentives. So one of such benefits is that the losses, incurred during the pioneer period can be carried forward. So what FRS will do is actually to do what they call post-pioneer audit to ensure that those losses are actually genuine. Those losses were actually incurred within the pioneer period. So, so basically, that's what that's what FRS we actually do, just to confirm that those losses were actually incurred by carrying out a post-pioneer audit to certify that. So FRS will certify both the qualifying capital expenditure and also confirm the that those losses were actually incurred for those periods. So if that is confirmed, the companies can carry forward those losses that was actually incurred during the pioneer period to post-pioneer period. Thank you very much.
Thank you very much, Mr. Matthew, for your response. The next question is, it could either be answered by you or Elizabeth. Do we have electronic portal or email or website where we can directly apply for this pioneer status? Do we have an electronic portal, email, or website where we can apply for it? If we do, please, could you let us have it? Thank you.
Okay, thank you for that question. And I like that question because it shows that manufacturing companies are really using digital transformation as an enabler of all aspects of their businesses, including applying for incentives. And it would interest you, Mr. Matthew would also bear witness that the FRS is also heavily invested in digitizing their processes. It would interest you to note that the NIPC and other government agencies are also following suit. So the COVID-19 pandemic, while it was very unfortunate and had very stark, devastating consequences, both for the health of people and for even the economy, the global economy. There were some things that COVID-19 brought with, I would call unintended consequences. And that was essentially the acceleration of the pace at which companies, economies, and even individuals were adopting digitization to facilitate their business operations. The NIPC was not left out of that. Prior to COVID-19, for every presentation that had to be made, you were required to go to Abuja to make that presentation physically. And during the COVID pandemic, the process was changed to facilitate digital submissions. So you can apply, you can submit your presentation electronically. The same thing goes with FIRS, which introduced the allowance or the ability to submit and file returns digitally even before the tax promax. So the NIPC also has the ability to receive applications digitally. We also make presentations to the NIPC digitally, and this has really enhanced the pace at which the pioneer status is being administered. So to answer your question, yes, you could submit your applications electronically, although you might, in some instances, need to submit the hard copy of the presentation just so that it could easily be assimilated by the team. But the presentation itself is also done digitally. So we do this by virtual means, and this has accelerated the process of the application.
Thank you very much, Elizabeth, for that. But we need the email or the website. Is it possible we have it?
Yes, indeed.
Mr. Martin?
Okay.
Yeah, the website, you can nipc.gov.ng/pioneer status. So you can actually leverage on that. You can actually have that. So nipc.gov.ng/pioneer.status. So when you go to the website, nipc.gov.ng, you can actually begin to look. When you see, you do a drop down. That's what we call Pioneer Status Incentive. Drop down there. You can actually begin to see the process. That website actually gives you the procedure and how you can apply. So there is also a form online. We see a new application form that you can fill online and submit. So basically, I don't know whether there is anyone from NIPC that can actually put more light to that. But basically, I'm looking at their website now. You can actually go to their website and you see the procedure given there, and also application form you can fill online and submit electronically. So I think that is what I can see on their website. So members can leverage on that. Thank you.
Thank you.
Thank you very much.
Thank you,
Mr. Martin. Okay. Also, we have another question here from a particular organization that started operations in 2015. And the question is, can we still benefit from PSI since we started in 2015?
Okay, so I'll take that. Thank you, Mr. Matthew, for that previous response. Also, in addition to that, there is a dedicated email that has been set up by the NIPC to correspond with pioneer status companies, specifically for the purpose of submission of applications and also receiving responses. And that email is incentives@nipc.gov.ng. So that is a dedicated website email where pioneer companies can submit their application. Now,
could you please take that again?
There is a dedicated email address that the NIPC have set up for the purpose of exchange of correspondence, and that's incentives@nipc.gov.ng.
incentives@nipc.gov.ng. Is that correct?
Yes, that's correct. Yes, that's correct.
Okay, thank you very much. So this particular question about an organization starting in 2015 and willing to benefit from PSI.
Okay, thank you, Dr. Segun. So as I mentioned, it's very important that you apply within a year. That being said, it's not all doom and gloom if you do not meet that threshold. There could still be a potential to apply for pioneer status, but that would be if you are doing something different from what you already started doing in 2015. So if you're an existing company and you do embark on setting up, for instance, investing in a new line and you're manufacturing new products that are different from the existing products that you were manufacturing in 2015, you could still submit an application to the NIPC to process pioneer status incentive on that new line.
Okay, thank you very much. The next one is, what is the difference between tax waiver and tax incentives?
Okay, so if you look at tax incentives are targeted at a particular motivation. So you have various types of tax incentives. You have profit-based incentives and you have cost-based incentives. Now, the pioneer status is an example of a tax incentive. A tax waiver is more of a process by which you are exempted from certain taxes that you're supposed to pay, which is then waived. Some of them can be by virtue of the law. For instance, when you have the penalty and interest waiver, you also have other waivers that are by virtue of instruments that help specifically to motivate a particular target. So incentives are targeted towards particular industries, they're targeted towards particular outcomes. Waivers, on the other hand, while similar, they are based on the background or information of, for instance, a waiver of penalties and interest. There could be waiver of custom duties. So they are interconnected, but they still are separate.
Okay, thank you very much. This question is directed at Mr. Matthew. How many years we carry losses forward?
Losses that have been certified by FRS can be carried forward indefinitely. As long as the company is going, as long as the company is going concern. So that is the current provision of the law. So prior to now, it can only be carried forward for 4 years, but now the losses that is certified by the service can be carried forward indefinitely, provided that the company is still going concern. So that losses can be used to offset future, can be net off against future profit.
And then would you like to let us know how to go about being certified by the service? How can we apply for that certification by the service if we have losses?
Now, what I mean certified is that, every company in line with Section 55 of CETA actually mandated to file their returns. So when you file your returns will show where you have profit or loss before tax. So where there are necessary adjustment, tax adjustment. So where FRS during their next review in the tax office or after audit or investigation, FRS through its audit team or investigation team will review the financials, review the tax returns. So where the losses are actually confirmed to have been incurred, after all adjustment. So that I said can now be carried forward. So the company can file returns showing losses. So that FRS job is to review the losses that have been reported by various companies. So those losses will now be reviewed by either the tax officer at the tax office or by a tax audit, because we do what they call tax audit. Is statutory, is enshrined in the provision of the law 66 of CETA, or investigation if the company is referred for investigation. So those are the process of certification. So where that is confirmed, then the company can now losses that is not absorbed, unabsorbed losses within a year can now be carried forward to the subsequent year. So if all adjustments have been made and there are still losses, so that can be carried forward to the subsequent year. Thank you very much.
Okay, thank you very much for that response.
Thank you. And Dr. Segun, I wanted to add to that. So in addition to what Mr. Matthew has said, also the IDA, the enabling legislation for the pioneer status, does prescribe that a pioneer company under Section 14(4) should file returns with the FRS for the purpose specifically of certifying those losses. So the losses that you make during your pioneer period can be certified by the FRS. This process is similar to certifying your assets during the pioneer period.
Okay, thank you very much, Elizabeth. The next one is directed at you now, Elizabeth. What is the minimum tax payment mark during the period?
What
is the minimum tax payment during PSI during this period?
Okay.
Is there a benchmark for the minimum tax that must be paid by a recipient or an organization that is seeking the PSI?
Okay, so the PSI has its principal legislation as the Companies Income Tax Act, and the Companies Income Tax Act provides for minimum tax of 0.5% of your gross turnover. Now, a pioneer company is exempt from minimum tax because the pioneer company does not even have accessible profits or total profits during the period of its pioneer status incentive. So for that purpose, the pioneer company is exempt from corporate income tax, even minimum tax and tertiary education tax during that period. This is subject to just the pioneer profits. In the event that the pioneer company conducts or embarks on a separate type of business during the pioneer period, that non-pioneer period will be exposed to corporate income tax and by extension, minimum tax and tertiary education tax.
Okay, thank you very much for listing the benefits. Next question.
Yeah, let me add also to what Elizabeth said.
Okay.
Because we also have a situation where a pioneer company may actually have pioneer be given certificate for pioneer products and also have non-pioneer products. So it is very imperative that the company prepare separate account for those two operations from pioneer products and operations for non-pioneer products. Because operations for pioneer products are exempt from tax, like she said, but you still need to compute your tax. You still need to do your computation. But the reason is that compute your accessible profit, compute your total profit, just that you not pay that tax. So you just still need to do that computation, just that you tax will not be imposed. When it gets to the point of tax, 0% because it actually exempt. So no company income tax, no education, no tertiary education tax. That's for pioneer products. So non-pioneer products, you have to pay all taxes, both company income tax and the other auxiliary taxes that actually give rise to those profits. So that's just the addition I want to bring on board. Thank you.
Thank you very much, Mr. Matthew, for that contribution. Next, the question we have here says, how can companies benefit from road infrastructure development and refurbishment investment tax credit? And what are the requirements?
Let me quickly respond to that. There is a committee that is set up by federal government when we have the Minister of Finance as the chair, the Minister of Works as the co-chair. So the committee is set up, and any company that undertake a project of the road, we have to submit kind of the report, the cost of those road to that committee. If that committee certifies, so that's what we call eligible roads. So there are roads that are eligible, there are roads that are not eligible. So we have what we call eligible roads. So when that is certified by that committee, then the company can enjoy that to be granted. So if that company has incurred that cost too, we need to be certified by the committee. Then when that is confirmed, the company will be given what they call road infrastructure tax credit. So the tax credit will be used to offset all taxes, and that tax credit is also tradable. You can actually sell that tax credit. So there's a committee that is set up. You can approach the Ministry of Finance and write the committee, and your request will be attended to by the committee set up by the federal government. So that's just that's my response to that question.
Thank you very much for your response. I have a question from someone who is joining us from LinkedIn. The question is that it is true that medical supplies are exempt from this tax. However, many accessories to medical devices, machines such as batteries, transformers, and replacement of parts for medical machines and other such components tend to be subject to tax. How should this be addressed by medical and allied companies?
Okay.
Okay, yeah, Elizabeth, go ahead.
So we need to understand the type of tax we're talking about. But if we look at it from a value-added tax perspective, the value-added tax does exempt pharmaceutical products, it exempts medical products. So the VAT modification order also specifically lists out items that are specifically exempt. And to make even clearer, the VAT modification order has the HS codes just to provide some level of clarity on the items that are specific, while it is also to be noted that those HS codes are not necessarily exhaustive. It does provide some certain level of guidance as to what exactly is exempted. So if you look at the VAT modification order, for instance, medical products have been defined, and it could to some extent be broad. Also, medical services have been defined. You also have pharmaceutical products that have been defined. And if you also look at the VAT modification order, the schedule that follows the 2021 VAT modification order, you see a long laundry list of medical items, medical equipment also that have specifically have the VAT exemption. Also, there are various fiscal policy measures that were released that has the equipment that are specifically exempt from VAT and their respective HS codes. So that can also provide some level of guidance. As Mr. Matthews said also, there's a lot of interventions that are underway for enhancing the healthcare sector and also alleviating the taxes and tariffs in the healthcare sector. There have been specific, it's been leaked out, so there can't be key references to this yet until the gazetted copy is out, but there's specific notifications or specific indications of some medical equipment, pharmaceutical items that will be exempted from VAT, in addition to what you already have listed in the VAT modification order. So it will be very good to look at the VAT modification order for 2021 to get some level of direction, because it does really define and expand the scope of medical equipment and medical pharmaceuticals that are exempt. Dr. Segun, you're on mute.
Oh, thank you. I thank you for that. So the question I was actually reading is, following an initial PSI granted, what are key requirements for processing a PSI extension?
Okay, capacity utilization, very important. Subject to satisfactory performance, there will be an evaluation of what a pioneer company has done pre-pioneer during the first 3 years and what it proposes to do in the next 2 years. So there'll be a lot of focus on capacity utilization, employment generation, sectorial growth, both from an industry and sector perspective, skills and technology transfer. The government is also looking at promoting environmental, social, and governance policies. So your CSR activities will also play a key role in determining your qualification for the next phase. But the key element that the government will be looking at is your utilization of local raw materials. So as a manufacturing company, there will be a review of your mix. How much are you importing? How much are you looking to backward integrate? There's also a very important need for the government to look at how relevant your industry is to economic growth. And based on analysis, it's still obvious, or it still appears from indication that the manufacturing sector still needs to be incentivized. So there will be a review of the economic importance of the industry to the economy. So to summarize it, capacity utilization, skill transfer to Nigerians, employment generation, and then the relevant importance of that industry to the economy.
Okay, thank you very much for your responses. They've been very apt and wonderful. Also, we want to appreciate Mr. Matthew Osaneku for your insightful presentation so far. We have requests from attendees that they would love to have your presentation slides. That's Elizabeth. If it's possible for us to share with attendees, we have their emails. We would appreciate if that is done. And then some are also requested for the video of this webinar, which I think it's also a possibility, but I would like to hear from you, Elizabeth, before we move to the next item on the agenda.
Okay, thank you very much, Dr. Segun. Yes, this is a recorded session and it's also live streaming. So to that extent, we have no problems with sharing the video because it's live streaming at the moment on our LinkedIn profile. So we have no problems with sharing this. Also, to the extent that it's already being streamed live, we also have no problem with sharing the presentation subsequent to our internal approvals.
Thank you very much for that wonderful presentation. So at this point, we have exhausted all the questions. Hello? Okay. So we have exhausted all the questions we have received, and we will we would like to invite Mr. Wale Ajayi, partner and head of tax, KPMG Africa, for his closing remarks.
Okay, good afternoon, and thank you so much, Dr. Segun. Let me start by thanking Elizabeth and Matthew for the presentation and the perspective that they've shared on tax incentives. Interestingly, when you talk about tax incentives in Nigeria, what you get some government officials talk about is the opportunity cost. That was the amount of revenue that government has forgone by reason of those incentives. But you don't hear often is the amount of jobs that is being created, as a result of the incentives granted. And of course, the impact, on sustainable development and on economic growth. I mean, there is no doubt in my mind that when you're talking about incentives, it does help to drive economic growth in so many ways. Number one, we talked about the fact that it encourages investment. When you look at investors, and one of the conditions they look at before investing in any country is the amount of incentives, right? And the nature of incentives that be available in that country. So incentives can help to attract investment. It also helps to stimulate innovation, because what it does is that it encourages companies to innovate, right? And then it results in new products, new services. It can obviously promote business development, especially when you look at your small businesses and big businesses and you're giving them incentives to expand, and to growth. And I mean, most importantly is the fact that it helps to create jobs. I mean, we know that when you give incentives, it stimulates economic development and new jobs are created. And of course, it can also help to enhance the competitiveness, of a particular industry to which that incentives, are given, especially if you want to promote that particular area. It can also help to foster diversification. We've heard that more than few times in this webinar. All right. I mean, you can look at a particular sector, a particular area of business, and you say you want to give incentives to grow that area. So it can help, to do that. And of course, it's helped to support infrastructure development. We spoke about the road infrastructure and development tax credit. Yeah. But again, before we even go any further, let's even talk about what do we even mean by tax incentives. And I know that some of the points that were made do emphasize that, right? First and foremost, I mean, I think one of the questions being asked is the difference between waiver and tax incentives. And Elizabeth, answered that. When you're talking about tax incentives, it can come in various forms, right? We're talking about whether you're talking about not just pioneer status. So it goes beyond the pioneer status incentives. So whether you're talking about tax credit that are being given, to encourage the investment in capital expenditure, or you're talking about tax reduction, it's a form of tax incentives, or you're talking about tax, deferral, or you're talking about, tax exemption or tax holidays. So those are forms of tax incentives. Of course, if you're talking about waiver, all you're basically saying is that a debt is crystallized or a compliance requirement is crystallized, and you're asking, for that debt to be forgiven, maybe like talking about interest and penalty that is due, or you're meant to file your returns within 6 months, right? And you cannot file within 6 months, so you ask for an extension. So that's a form of a waiver of a compliance obligation. So that is a bit different. But what I would like to focus on, and which is very important for us to understand, that we've spoken about the need and the importance and the crucial role that incentives play in the economic growth of a country. I want to focus also on the practices. All right. When I look at what we have in Nigeria, one of the things that we don't do that often is, trying to evaluate or define a performance incentive or key performance indicators for incentives. In other words, how do we determine whether they are effective or, or efficient in delivering the objectives? I know that the NIPC, at times does an impact assessment, but you have to go beyond the tax holiday and look at all the incentives in the books and ask ourselves, how well do they achieve the stated objective, right? The other thing that is very important, is that it must be targeted. We need to say to ourselves, right, which industry, which segment of the business do we want to grow? Do we want to, expand? And then make sure that it is targeted that, to that particular incentives. And then it must be transparent. Everybody must understand the conditions, right? We've spoken about the eligibility criteria for pioneer status incentive. It must be clear to everyone, and it must be clear what they need to do to be able to assess those, assess those incentives. It shouldn't be something that is limited or restricted, to some few people. And one of the things that I have always wondered about that I don't think we do very well when it comes to incentives is in reviewing, our incentives, and also asking ourselves, not waiting for the sunset provision. Maybe you set the tax incentive for 10 years. For example, we spoke about the road infrastructure credit, right? For 10 years, right? Started in 2019. So by 2029, it will end. That's the sunset provision. But every now and then, maybe every 3 years, we need to look at ourselves, ask ourselves, is there anything we need to do to reform the incentives or the way it operates? We don't need to wait for the 10 years before we do that. So we need to do periodic review, right? For us to be able to understand whether we need to make some modifications, to that program, or not. And I think one area for me also that is critical is asking ourselves whether we need, to apply a ceiling, right? When you look at most developed countries, right, anytime a tax expenditure or a tax incentive is given, the very first thing that must accompany that statement, right, is a statement of the impact on the financial obligations. In other words, how much of revenue will be forgone, and what does government need to do as countervailing measures to offset the revenue that will be forgone. So we need to have that in place. So we might need to set a ceiling and say in every year our tax expenditure, right, which is the revenue forgone, may not exceed a certain amount, a certain percentage of our GDP. I mean, that's something we don't do well in Nigeria, and it is something that we must do, right? Every now and then. And there is no doubt in my mind that if we continue to evaluate the effectiveness of tax incentives, right, it will deliver, the desired growth in Nigeria. And for me, when I look at, the manufacturing industry, surprisingly, just a couple of weeks ago, Stanbic IBTC, releases the Purchasing Manager Index, which is a composite PMI, Purchasing Manager Index for Nigeria. And it shows contraction. I mean, it's obvious why we should have contraction. I'm sure that's about 49%. When you look at the manufacturing PMI, I'm sure that will probably be in the low 40s or the late 30s. And it's obvious, given the challenges we've spoken about, high energy cost, access to foreign exchange, capacity utilization, cost of borrowing, right? So if there is one sector in Nigeria that actually needs to be incentivized, that sector is manufacturing. And it's just because of the contributions that it makes. Yes, currently, it may probably contribute to about 10% to GDP, but I think with the right incentives, with the right infrastructure environment being created, right, we can actually increase, the contribution of manufacturing to GDP. And I think this is one area that the Manufacturing Association of Nigeria really needs, to engage with government, to see how, what kind of incentives they need to be able to grow that sector, especially now we're talking about after, right? How can we ensure that we're competitive, right? That Nigeria doesn't become a dumping ground, and we can see the impact from the foreign exchange that will be created, if we start manufacturing for export. So, so I just want to thank Elizabeth, for the perspective that has been, shared, on this platform, and also, for facilitating this. I think at the end of the day, it's about taking advantage, of the incentives that are available. Now that we know of those incentives, I know that Elizabeth took her time in explaining the incentives. It's not just enough for us to know, but the question is, what do we do now that we know what incentives are available? We need to be able to apply. So thank you so much, and I hand over to Dr. Segun for the rest of the program.
Thank you, Wale.
Thank you very much, Mr. Wale Ajayi, who is the partner and head of tax, KPMG Africa. It's been wonderful since we got started. We would like to use this opportunity in the absence of no other question or comments. I would like to give Elizabeth 1 minute, your closing remarks, and then Mr. Matthew, your final thoughts before we bring it to a close. Let's start with you, Elizabeth.
All right, thank you, Dr. Segun. Thank you to the distinguished guests and participants. Thank you for your active participation. And I really want to extend my gratitude on behalf of the KPMG partners and staff to the Manufacturers Association of Nigeria and its leadership for enabling us collaborate on this very important topic at this time. It's a privilege to be able to engage with your members at a time where the economy is facing a turning point and manufacturers are really bearing the brunt of it. We'll be really happy to engage further and to continue the sustained collaboration with MAN and its members. Thank you very much.
Thank you very much, Elizabeth. Now, Mr. Matthew Osaneku.
Yeah, thank you very much. From me, FRS is committed to partner with MAN to ensure that they fulfill your tax obligations. And also want to state that the law, the tax laws that, as we have the Eastern tax laws, has a lot of tax incentives that members can take advantage. So it's there for you, compute your tax, take advantage of those tax incentives, and FRS will gladly going to support. And also from FRS, we have actually restructured, and there is this customer relationship management that actually now on the fore. So we have the large tax, medium tax, and the emerging tax, where we got the small tax group. So that we can know our customers, and we're going to support our customers. So we want to continue to support the taxpayers, especially the risk sector, to ensure that you continue to grow. And as you grow, by extension, the economy will also grow. So on this note, so thanks for having me on this call. Thank you.
Thank you very much.
Dr. Segun, if you don't mind, can I just say one statement, make a statement, right, to address an elephant in the room, right? Can I go ahead?
Go ahead,
just for 2 minutes. Okay. I know that everyone, especially manufacturing companies and taxpayers in Nigeria, everybody's heard about, BEPS Pillar 2, which speaks about the global minimum tax of 15%. And of course, people are always wondering, how does it impact on the status in Nigeria? What I can say to you is that, BEPS Pillar 2, which is that 15% minimum tax rate, is only meant, for, multinationals, right? So the whole idea is that if you have, it also gives countries the ability to review, their incentive system. So if you have a multinational company that is paying or that has less than 15% effective tax rate in Nigeria, what it does is that multinational company will then have to pay a top-up tax, right? So it's not meant to discourage investment, but rather it gives government the ability to actually review the incentive system just to ensure that they're not leaving money on the table. Because if you're not collecting up to 15% minimum tax in Nigeria, what that means is the Nigerian trading partners, will collect that money. So it's not meant, to discourage investment, but rather it is meant, to discourage the use of, what I call damaging tax incentives, the race to the bottom, right? Which most countries in Africa tend to do, right? Ghana reduces its rate, Nigeria does the same thing. and Angola does the same thing. We continue to reduce our tax rate to the detriment, of the national economy. So people don't need to worry. So it's not going to discourage investment, but rather it's just meant, to discourage race to the bottom. So I just thought I should mention that since we're discussing tax incentives. Back to you, Dr. Segun.
Thank you very much, Mr. Wale Ajayi. At this point, it's time to move the vote of thanks, and we want to appreciate the collaboration between the Manufacturers Association of Nigeria and the Federal Inland Revenue Service, and our key partner in this webinar series, KPMG Nigeria. We appreciate the collaboration. This is only the beginning of this rewarding partnership, and we look forward to engaging with you in the nearest future so that our members, the manufacturers who are the makers and the shakers of the real sector, the builders of the economy, can enjoy benefits from the government. So on behalf of the President of the Manufacturers Association of Nigeria, we want to thank everyone for finding out time to participate in today's webinar. Thanks to our Director General, Mr. Segun Ajayi-Kadir, MNI, for being with us all through. We appreciate your presence, DG. Also, we want to thank Mr. Wale Ajayi, Partner and Head of Tax, KPMG Africa, for wonderful support and also your presentation. Very insightful. We also want to extend our appreciation to Ms. Elizabeth Olaghere, Partner and Head of Tax Incentives with KPMG West Africa. Thank you for your presentation, and thank you for taking our time to be with us today. Also, we would like to thank Mr. Lucky Obadodeke, Director, Large Tax Manufacturing and others, who is ably represented today at this webinar by Mr. Matthew Osaneku, Deputy Director, Tax Policy and Advisory. And also to all attendees and participants, members of the Manufacturers Association of Nigeria, we say a big thank you and God bless you. On this note, we have come to the end of the business webinar series, co-hosted by Manufacturers Association of Nigeria and KPMG. Thank you and God bless you. Bye, everyone.
Thank you. Bye.